am very excited for this one, not just because I'm on stage, but because we have the honor of hearing from Mark Minervini, one of the greatest traders of our generation, as well as Richard Moglen, also known as the second greatest trader of our generation. So, without further ado, once Mark's on screen, we're going to get right into it. I'll leave my cues to the guys in the back.
Hey, Mark, how's it going? Can you hear us okay?
I can hear you now.
Perfect. Well, let's go ahead and get started. Welcome, everybody, once again to an interview with Mark Minervini. My name is Richard Moglen, and today we have the honor of interviewing Mark, who is a two-time U.S. investing champion. He's also the author of multiple excellent trading books and mindset books, including Think and Trade Like a Champion and Trade Like a Stock Market Wizard. And I'll leave it to Gav to start with some opening questions.
Absolutely. So let's get right into it with a little bit of background. Now, many of you may have heard of Mark, but I think it's important to understand, Mark didn't just wake up, and get born and he was a trading champion, right? There was some background to this. Something made this happen. So Mark, I'd love to hear from you a little bit on how did you even get started in the stock market? When's the first time you heard about it? And what made you say, this is something I want to do?
Well, first of all, let me just say I'm happy to be here, and I'm sorry that I couldn't attend in person and meet everyone and shake hands, and it would have been a lot of fun, but at least I'm here virtually. Hope that you guys are having a great event. I'm sure it's beautiful out in Vegas. When I first started in 1983, so a long time ago, probably a lot of you guys, certainly you, Richard, and some of you young guys, that of course I know you guys from University of Maryland, and for quite a while now. You guys probably either weren't alive or certainly were little babies in diapers. So it's been about 39 years now since I've been trading the stock market. I started off doing the exact opposite of what I do today. I started off buying stocks, 52-week lows, low price stocks, low PEs, value buying, doing just about everything in the complete opposite of what I do now. And I had miserable results for about 5 or 6 years. I didn't even make money. Then I flipped everything around and started making money in the late 80s, around 89. By the time 1990 came and the 90 to 91 bull market, I was pretty prepared to take advantage of it. And that was where things started really turning around for me. But funny thing, I don't know, when I was like 8 years old, I used to love looking at the stock tables. I didn't even know what they were. And I used to look at the stock tables, and I used to play these little games while I would circle things in the stock tables. So I don't know, maybe I was destined to be a stock trader.
I love it. So 1980s, so you're starting out, and what's the first strategy? So you're saying you're buying those 52-week lows, and so you're using a bit of technical analysis being implemented into it. When you're first starting out, were you looking to others to garner these strategies? Were there people who were perhaps, giants in the trading world at the time that you were attempting to copy or learn from?
You're showing how young you are. I didn't know anybody. There was nobody to know. There was no YouTube. There was no internet. There was no nothing. So to be honest with you, I can't even remember, who even would have inspired me, in the very early period to get involved with stocks. But you said technical analysis. I didn't have technical analysis. I didn't even know what technical analysis was. I bought a company called Alice Chalmer. It was a company that made forklifts and tractors at 4 1/8, and it went up to $8 like within a couple months. And I said, wow, this is easy. And I just thought that was the way. You just buy low price stocks. And then I got some advice from a broker, and he had me buy this company that had a drug for AIDS. It was supposed to have an AIDS vaccine. It was called Imereg, was the name of the Imereg Class A shares. And he blew me up. He had me buy it all the way down. He kept saying it's a once in a lifetime opportunity. The stock went down 50%. He said, buy more, went down more. And I just kept buying it, and I ended up blowing up my whole account. And then I had to rebuild all over. Then I tried to get it back real fast. So I went into options. I blew myself up there. And then that was sort of the best thing that could have happened to me.
Sounds like a lot of early struggle, something I'm sure many of us can relate to. What was some of the ways that you took these early struggles and learned from them? Where was the turning point?
Well, I mean, the turning point, well, first of all, William O'Neill came out with Investors Business Daily. And I went to an O'Neill seminar. David Ryan, many of you know, has worked with me for many years, presenting in the Master Trader program. He's a very good friend of mine. At the time, of course, I didn't know David Ryan, and I didn't know William O'Neill, but I went to the seminar. I read O'Neill's book. So I started off really, moving in the right direction from O'Neill. I also read Richard Love's Stupid Performance Stock book. And what happened is when I read O'Neill's, I realized, I said, wow, this sounds very familiar. And later on, many years later, when I did a lot of research, I realized that O'Neill was influenced by Love back in the 60s. And he took basically Giller's work and Love's work and put it together and came up with CanSlim. Many have heard, of course, of the cup with handle pattern that started off as a saucer and platform from William Giller's book, and O'Neill just retermed it. And then all the factor modeling that he did was really just a modern day version and with better computer power of what Richard Love did.
Love it. All right, just a couple more introductory questions here, and then I'm going to turn over to Richard to really dig into the trading style. So one other question I have is, and the reason we're all together here is because of this idea of FinTwit, right? Finance Twitter. What caused you to hop onto social media and start sharing some of your insights, over the last year, even 2 years, while we had this run up? You were consistently posting insights saying, this is going to hurt retail traders. There's going to be this downfall, right? Just trying to be there for people. And you've amassed a large following, right? 400,000 followers verified on social media. What made you want to grow on this type of platform and engage with people there?
Well, everything that I do today, from the books to the seminars to even the service that I have, really came by accident. I didn't mean to even get into this business, not by a long shot. I was actually retired, as a trader, and McGraw-Hill was after me to write a book for like 10 or 12 years, and finally, I decided to write the book with McGraw-Hill, my first book. And from there, I just got people contacting me saying, do you have a newsletter? Do you do a seminar? All these various things. Twitter, I hopped on because, someone just told me about Twitter. I actually got offered to invest in Twitter before Twitter was even public, or even not, and I don't mean public as a stock, I mean public, like before they were even an operating platform. And I thought it was a terrible idea. So I said Twitter, it sounded so, the name sounded so quirky. And I said, I don't want anything to do with it. And of course, it ended up being where I've been on Twitter since 2010 now. So yeah, and over the years, even with the little workshop that I did, the workshop was a testing ground. When I was working up information for my book, I used it as sort of just to test the information to see what resonated with people. And then, because when you're live and you're with people, you get to see exactly, and you meet them. You see exactly what resonates with them and what strikes a chord with them. So it was all sort of just homogenous how it worked together, and then it just turned into a business. And now, of course, years later, I have a lot of books, and it's turned into a pretty nice business. Where and again, every year, whenever I do the seminar, probably for the last 7 years, my wife and I would always say, no, this is the last one. I'm not going to do this again. Then all these people would come up and hug me and tell me how great the information has helped them and changed their lives, and say, okay, one more year, and now it's 12 years.
I love it. So final question here, following up on the Twitter concept. There's a lot of different thoughts about how people engaging and communicating via Twitter can assist or hurt their trading, right? We fall into often a bit of a groupthink mentality where people are now just following others into trades, and that doesn't often work because they don't get told when to sell, right? It's just the buy signal. But then on the other side of it, there's so many people who have learned new styles and learned from people like yourself. Do you find any value personally? Do you learn anything from that FinTwit community? And do you think that there's value for others to be a part of it?
Well, we can learn from people that are doing things wrong. We can learn. I learned a lot from, early on in my life. If you read my mindset book, I had a lot of bad example in my life, and I learned a lot from that, what not to do. So we can learn from anyone. I learn from everyone. So teaching is a great way to learn. But when I first started trading, I was going to the library and I was reading books that were outdated and on strategies that never worked in the first place. So there was no information. It was very hard to get information. Now you have the opposite. You have information overload. You have everybody's a self-proclaimed expert, and you don't know who to listen to. So both have their pluses and minuses. I'd rather have the information overload and have the information available, and then you have to sift through it and figure out who to listen to based on track record and reputation, I guess.
Love it. All right, we're going to start digging in now to the real nitty gritty with the trading, the strategy, the style. I've been talking a lot, so I'm going to turn it over to Richard to get us started there.
Perfect. Thanks, Gav. And Mark, just to kind of give people a frame of reference, if you could just kind of describe a little bit about your overall trading style, how you would describe yourself as a trader, I think that would help everybody who maybe isn't as familiar with your work.
Well, okay. Well, I mean, I wrote books on this, so you can read, my books and see everything that I do. I mean, my style is what I would call a conservative, aggressive opportunist. And mainly what it means is that I pursue very, very aggressively the long side or whatever side I'm trading from a very low risk standpoint. So I'm trying to find, relatively speaking, large reward versus my risk. I'm extremely risk adverse, but I'm also extremely aggressive. So I call it a conservative aggressive style. It combines technical analysis, fundamental analysis, all culminated together. And then I try to time trades at a point at which, not as much of trying to be right all the time, but just I want to know if I'm right or wrong very quickly. So even if I'm wrong, I want to know quickly so I can move on and then move on to another trade, because compounding is what's real important to me, is turning over the money and compounding it very rapidly. And that's how I get those big returns.
What kind of rules regarding risk management, respecting stop losses, keeping track of, changing environments have you kind of developed over, your career as a trader that have kept you in the game and kept you out of the worst of the bear markets?
Okay, so first of all, I think we should mention that this particular environment that we're in right now is a great time where I think people are open-minded to talk about risk. Some people who might not have, maybe they were too new to the game or got rewarded for having a strategy or an approach that didn't have much of a risk mitigation part of the plan. Let's just put it that way, professional and amateur. So now that you talked about the 50-80 rule, we certainly can talk about that. Now that we've seen stocks go down, many stocks, 50, 60, 70, as much as 80 and 90%, there's a lot of people that didn't realize that this could happen, and it can happen in such a quick fashion, and it can happen even in some of the big names that they never thought could fall. So I mean, in all the time that I've been doing this, and if you ask William O'Neill the same question, or ask any of the traders that I've known, that I've respected and have long-term great track records, none of us have figured out a better way to manage risk or to avoid a big decline other than taking a small loss. There really isn't another way without putting on more risk. I mean, people say, well, you can hedge and write options or buy puts and so forth, but that's just adding risk. You can lose on both. So again, that's the most basic. Now it sounds easier than it is, because there's also a downside to that. There's always two sides of the coin. When you use a stop, you could get stopped out many times if you're not using that properly and timing your trades properly, and you're buying extended stocks, or you're fighting the market when it's in a downtrend. You just keep trading and trading and trading. You could get death by 1,000 cuts and blow yourself up with stops. So it's not a free ride, but it is the starting point. And you asked before what was the thing that turned me around, and I talked about this in my book and many times before, where I started hearing, of course, about cutting losses from O'Neill and some of these guys, and I said, okay, I was cutting my losses, but every now and then I wouldn't, and I would get a big loser because I'd fall in love with the story, or the stock would go down so fast that I would say, okay, well, I'll wait for it to come back, and then it'd go down even more, and I'd say, okay, well, now I'm down too much, I can't sell now, and now it's down 30% and then 40%, and before you know it, I'm throwing in the towel, down 60%, completely blown up and demoralized. Everybody can relate to that. We've all done that. So what I did was I went back and I said, arbitrarily, let me just see. If I went back and I don't remember how many trades, maybe 150 trades or so. I said, let me just see if I had cut these losses arbitrarily at just 10%. And even the ones that I cut shorter, like 5% or 7%, I made those larger to 10%, but I made all the big ones smaller to 10%. What would my performance be? At the time, I was down about 15% on my account. I ran the numbers, and it came out to where I would have been up almost 80%. So I said, there must be something wrong. Obviously, I did something wrong with the calculation. That can't be. So I ran it again. And sure enough, it was the same numbers. I ran it a third time. It was the same numbers. So I learned very quickly that, wow, protecting the downside could really shift the whole equation. And then I started looking into how futures traders were trading. I met one gentleman who was a very successful futures trader, and started using probabilities and analyzing probabilities and using bell curves and things like that. And I really dug into the math, and that's where everything changed when I started. My focus became on the risk-reward relationship as opposed to just trying to find a big winner.
Absolutely. And another key topic that you discuss in your books is progressive exposure, which I think is something that's extremely beneficial to learn about. So could you describe a little bit about what that is and how you take feedback from recent trades and basically use that as a guide to either scale up or scale down, so you're trading your largest when you're trading your best, and you're not really exposed when you're trading at your worst?
So the goal of any trading strategy should be, of course, you want to make a profit. We ask most people, what's the goal of your strategy? To make money, right? Okay, well, maybe we take it even further and say, well, the goal is to make more on my winners than I lose on my losers. Okay, that's the holy grail. But the real goal that you really have to be careful, you have to try to focus your strategy in this direction, or in these two directions are, you want to make sure that your strategy forces you to be trading your largest when you're trading your best and your smallest when you're trading your worst. And that you want that to be sort of automatic. You don't want to have to say, oh, well, I like the market here, and now I'm going to trade larger. You want to have some type of mechanism that forces you to trade larger when things are going well, and forces you to trade smaller when things are not going well. And that the reason why is because the average person, what they normally do is they'll when the market takes off and it looks extended and it looks like it's overbought, and they get some profit, they sell into it, and then there's a lockout rally happens, and they sit there and they just watch it, and they don't make any money in the bull markets. And then when the market rolls over, they think it's oversold, and they start trying to double down and get even. And before you know it, they're trading large into a downtrend, and they're trading small into an uptrend, or out during the uptrend and in during the downtrend. So you want to be, when the bull markets are happening, you want to be heavy. Stanley Druckenmiller said, you got to be a pig. Every now and then you got to be a pig in the market to make big money. You also have to know when to be a chicken. So to me, it's sort of, knowing that shifting between pig and chicken is really, I think, one of the keys to the difference between a real professional trader and everybody else. This is something like Mark Ritchie, who, is side by side with me daily, and we discuss this stuff all the time. He's really good at that. Him and I both are really good at stepping on the gas. When things are going really well, we'll slam it to the floor and just get incredibly aggressive and make tons of money in just a short period of time. And then we have the luxury of sitting out for extended periods of time and not fighting when there's all this noise and the market's difficult. And then we're in cash. And I'm always in cash when the market's in a downtrend. I've never been caught in a downtrend ever. Not even when I didn't know what I was doing in the beginning. In the '87 crash, I was even out. I would at least bend with the market somewhat. So that's the key.
Perfect. And I kind of want to dive a little bit deeper into that and maybe use an example. Given we're in a correction now and a lot of people are completely in cash, say we do see setups start to emerge. We see those leadership groups starting to show relative strength. How would you go about putting on some test trades, and then if those start working, increasing that size, and how fast would you do it, and what kind of position size would you get to?
Okay, so I forgot. I'm sorry. I didn't really address your question. Your question was about progressive exposure, or at least your comment was. Progressive exposure it's a concept that I think is misunderstood by most people, but you should really, that's the concept you should really dig deep into, my explanations, and then work with it, because it goes hand in hand with your risk management, with stop losses. And a perfect example is, if the market were to start, or let's just say stocks were starting to set up, and there was some stocks that met my criteria, I wouldn't just plunge in and just start buying like crazy. I would buy some small positions and see if they work from a very low risk standpoint. So I would have smaller positions from a very low risk. So overall, my risk would be very, very small. So I can do that a bunch of times and not get myself in trouble. So now if I get some traction, I've now gotten some profits, and I would use those profits to then finance a bigger position. That's now financing my risk. And seeing as you're in Vegas, I might as well use a poker analogy, because I always use poker analogies. I used to play a lot of poker in my day. And when I used to go to the casino and I'd play on the regular game that I normally played was a 10 and a quarter game, no limit. But a lot of times you couldn't get on the table. There would be, a wait list. So I'd go play on a smaller game, like a 1-5, a 1-2, or a 2-5, or even a 5-10. So the goal was now two things can happen. Sometimes, you go on the 1-2 and you're normally playing this big game. So you're like, oh, this is just a little game. You start throwing chips. And before you know it, you're at a pretty good loss because you didn't take it seriously. That's number one. But the key that I would try to do is I would try to build up a little bit of a bankroll on that smaller game and work myself up, and maybe work to the 2-5 or the 5-10 table and build up a little there. And then when I get to a larger game, around tournament time, there would be 20, 25 quarter and a quarter games, 50, 100 games even. These are big games. I want to go into those games with some profits and have some cushion so I don't have this pressure on me. So I would build myself up. So I think progressive exposure might have happened with my stock trading. It might have actually been a natural progression from my poker playing, because that's how I played poker. I would always, even if I start playing, in a game where I know people say, well, aces are, you should just shove in with aces all the time, or, with certain probabilities. And they just play aggressive right off the hop because the odds are the odds. But you have to remember, those odds are over 100,000 hands or 1 million hands. I mean, I've lost with aces four times in a row and shoved in all my chips in a big game and ended up with a gigantic loss. So relating that to the market can stay bad longer than you can stay solvent. So you can't think of it in probabilities that way. You have to there's a risk of ruin. And depending on the size that you're trading, that risk of ruin, of course, is larger or smaller. So progressive exposure is simply just building small success leading to larger success, and building into your larger positions, and building down too when things aren't working.
Perfect. Yeah, I think that's an excellent explanation. And given that we are in a correction, I want to dive a little bit deeper in terms of what you're doing on a day-to-day basis to stay on top of ideas that are maybe shaping up. So Mark, do you have any kind of go-to scans during periods like this where you're looking for that relative strength, you're looking for leaders that may be developing? What are you kind of doing on a day-to-day basis to try to find ideas if the conditions start to improve?
There's no magic scans. I mean, I'm using the same scans that I've been using for 30 years. There's no magic scans. That's the least, if anything, you want to learn, from what I do, the last thing would be the scans. I mean, I can give you a few utility scans that I would use during certain periods, markets that are in corrections, but generally I'm looking at the higher relative strength names. And once I find, names that are in an uptrend, of course, in Market Smith are my trend templates. You're going to want the stocks to be in an uptrend. You're going to want the stocks to be in bases, have good relative strength. And then from there, then I look into the fundamentals, see what the company does, and categorize the company and figure out if this is a turnaround situation. Is this a cyclical? Is it a institutional favorite, maybe a stalwart, or is it a true market leader? And then that's how I approach it. That lets me know how I need to approach it. If it's a drug stock, I'm going to not be looking at earnings because 80% of them don't trade on earnings. So I'd be trading strictly off the chart. So categorizing the company and going through that is more important than, the actual screen. Now, as far as when you're in a correction like you are right now, sometimes what I'll do, let's just say you're in a 10-week decline, I'll run a 10-week relative strength and then just see what's held up throughout that decline. You could also run a relative strength new high screen. Like that's a good screen to run when you're in a correction, because now you can find stocks that to get a relative strength moving up, it doesn't have to be where a stock goes up. It could be that it's just going down less than the market, or even just going sideways, the market's going down. So at that particular time, in a correction, I'd be looking for, relative strength, new highs. So that's what I call utility screens, where in certain instances, I will run a few of these different screens that'll apply for that particular moment in time. But that's about it. Otherwise, there's no real magic. I run an IPO screen. I'm always aware of all the IPOs that came public in the last year, and watching those. But the screening is actually quite basic. It's the rolling up the sleeves and doing the real work. That's where the work is, and where
perfect.
the magic comes from.
Yeah, perfect. And Mark, one thing I've always been impressed with is kind of your discipline and how prepared you are. So I want to ask you kind of how you set up your daily routine. So every day when that trading bell rings, when 9:30 Eastern time hits, you're ready and you're ready to go and to act on any ideas that you have in the market.
Well, most of my work's been done the night before, so I'm not really doing a whole lot pre-market except seeing if the market's going to be up or down big, checking, if earnings reports came out and so forth, standard things of what would affect my portfolio. I prepare in the morning. I do 10 minutes of deep breathing and mental visualization prep before I even get out of bed. I turn the TV on first and just see if the market's down 1,000 points, then I know I got to start doing visualization about cutting losses and handling stocks that are going to have me under pressure. And then, I just go and I look at my list, my watch list, my buy alert list, what's on deck for potential buys, and see if they're going to gap. And that's about it. I mean, I do the same thing over and over. I've been doing the same thing. People always ask if anything's changed with all the technology. When I first started doing this, I was charting on graph paper. I was physically hand charting stocks. I was hand plotting moving averages. I was hand plotting oversold, overbought oscillators. I was doing everything by hand. I was going to the library and going on microfiche and Barron's and Wall Street Journal to get data and then back test things. I mean, you want to talk about really, really arduous, roll up your sleeves work. My sister and her friends, I would pay them a couple dollars an hour to calculate moving averages and things for me by hand on paper. I had all these stacks of these books and everything that I had of calculating all these statistics. So it was really, you would think that now you would have this technology that would do all that work for you. Yes, it does calculate the charts and all that, but there's nothing. I'm doing the exact same thing. It's on a chart. There's no real advancement of any kind of real magical thing that the technology is going to do the work for you.
Perfect. And I'm going to ask one more question, coming back to the 50-80 rule, and then I think Gav is going to move on and talk about the championship last year. But Mark, we've touched a little bit, and I think you mentioned the 50-80 rule, but some people watching might not be familiar with that. So speaking of going and doing studies, can you kind of talk about the work that went into looking and finding these statistics, and also kind of how you apply it day to day in your trading?
So everything that I do is not just based off of some idea off the top of my head. It's based on real scientific testing that goes back, and not back testing. Okay, there's a real important distinction between back testing and then what I do or someone like William O'Neill has done, which we call factor modeling. Big difference. The difference is testing. You basically check everything and find out what works, what gets you to a result. So you go back and, I mean, if you took and went and analyzed the pattern of beetles scurrying around, you could probably find some pattern. Now that's how you get the NFL indicator, and you get all these crazy indicators, which is all bullshit, because it's just curve fitting. You're just curve fitting and finding whatever gives you the answer that you want. Factor modeling is the exact opposite. Think of it as you're going to go and get a baseball player for your team. You're going to go back and you're going to go find out, get someone who's got a great batting average. You're going to go and you're going to see what are the characteristics of a great player. And then you're going to go and pick your players based on that. So factor modeling is you go back and you find out what had performed and then look at the characteristics. Or think of it as, looking at an Olympic athlete and say, okay, well, let me go look. Is there something that these people eat? Do they all eat the same thing? Do they all do a certain type of exercise regimen? Do they think certain thoughts? And going back and finding what are the similarities and the commonalities among those great athletes. That's what we do with stocks. So, that's, I don't remember your question, but that's the starting point. That's the starting point of of factor modeling. Everything that I do is all based on that. And I guess it was the 50-80 rule you were talking about. 50-80 rule states that, and this is just going back and looking at history of secular leaders. When a leader tops, when I say a leader, like a stock like a Netflix or a stock that has led the cycle, sometimes a stock that's led late in the cycle, like a Zoom or something like that. When these stocks top, after they make these big moves, there's a 50% chance that they'll go down 80%, and there's an 80% chance that they'll go down 50%, generally speaking. And the average decline of those secular leaders once they top is about 70%. And generally speaking, they don't come back and recoup that for at least 5 years, and in some case, 10 to 20 years. So that's a very, very ominous set of figures. So you don't want to be around a leader after it tops. It tells you that the probabilities are really, really stacked against you. I know what works for me, and I'm an expert in one particular area. And that's one thing I would suggest, is that you make sure you master an area. If you're going to do the bottom fishing thing, we'll be the best bottom fisher in the world. But the thing that I am against, and that is having any of those strategies without a plan for the risk side of the equation, because you're going to be wrong. I don't care how good your fundamental analysis is. I don't care how smart you are. You will eventually be wrong. You will eventually be very wrong. And at some point, you will be wrong for a long time. So you have to have some mechanism that protects you, because big returns mean nothing if you have big drawdowns. It'll all be given back, and you'll underperform, and you won't be consistent. And consistency is the key to longevity.
Yeah, awesome. And yeah, I think that's a really important reminder. And I'm going to hand it back off to Gav to talk about the championship, I believe.
Yeah, before we go into the championships, sure. I have one other question on the trading side of things. So, Mark, you mentioned, the only way to avoid these, casualties of recessionary state economies is to have those quick cuts. And you mentioned even if you had cut at 10%, right, you would be up 80% that year. I'm also curious on the opposite side, at what point you start taking profit. And I'd be curious, I think that 10% might have just been perhaps an arbitrary number, or perhaps that is that number. Where is that number on the downside where you cut personally? And then on the opposite side as well, when do you start to take profit?
Okay, well, there's a number of things there that you just brought up that can go in a lot of directions here. So first of all, as far as the number, can you hear me?
Yes, sir. Okay.
As far as the number, and you said quick cuts. No, not necessarily quick cuts, or not even necessarily really, really small cuts. And when I say cuts, meaning, cutting out of the position, I think that's what you mean. Yes, so relative to your upside, okay, the math has to work. It's that this all comes down to math. At the end of the day, this all comes down to math. You have to make more on your winners than you lose on your losers, or you would have to be right many more times. If you're going to have a bigger loss than you have a gain, then you would have to have a very high batting average. Either way, those numbers, those are like three moving parts. I call it the trading triangle, like photography. You've got exposure, you've got shutter speed, f-stop, the triangle. Those three give you your exposure. Same thing with trading. Those are your three moving parts. Now, the number, the math, let's start with the math as far as the number. When you start getting into double digits, when you take a 5% loss, it takes about a 5.4, something like that, gain to get even. It's about apples to apples. When you get to a 10% loss, it takes an 11% gain to get even. It's still not way off. You're losing 1%. You get to 20, it takes 25. You get to 50, it takes 100. Or if you let stocks drop like some people have in this market and you're down 90%, it takes 900% to get even. And I don't know too many people who have too many 900% winners. So there is a mathematical number where no matter how good you are on the upside, it doesn't make sense to let a stock drop X amount. So that's the starting point, all right? So we found that number is at 10% is where you start really going underwater. And if you can't get it right within a 10% range, then you've got a problem with your timing. Okay, these people, they say how good their research is. No, our research is the best. We're so smart. This stock's undervalued. And then they're down 60%. Your research isn't that good. If your research was that good, the stock would go up from where you bought it, because your timing, obviously your research has nothing to do with timing. And okay, my time frame's long. So what? Your time frame's long. That doesn't mean anything. The stock doesn't know how long you plan on holding it. You're at a loss. So, and you're losing compounding time. So bottom line is that regardless of the strategy, you're going to have to do that math. Now, if your average gain is 50%, you could obviously weather a much larger loss than you can weather if your average gain was 5%, or if you were a day trader and it was a half a point. So that's the math that you have to, you're going to have to figure out. But there is some uncle points where it really doesn't matter, because it gets to where you're at the point of no return. Let's see, what else? I had another point, but I forgot what it was. I should have wrote it down, but it'll come back to me.
Might have been on when you start taking profit.
Well, okay. So again, this is based on, the reward has to pay for the risks. So again, you have to decide what type of strategy, what type of style, what type of approach you're going to use. Are you going to be relying on turnover? Okay, look, if I gave you a coin and I said, hey, you're going to get $2 on heads, you're going to lose $1 on tails. What is your goal with that coin? What would your goal be with that coin? To flip it as many times as you could, right? You want to flip it because it's a 50-50 proposition. You're getting paid $2 every time it goes on head. So every 2 flips, you're making $1. So I want to flip that coin if in 1 year I can flip it 100 times, I make $50. If I can flip it 1,000 times, I make $500. So that's the goal. The goal is to flip it as many times. So you have to figure out if you're going to go for the big move. You're going to be a short-term trader. You're going to be some day trading scalper, and then from there, that's where you decide, what that gain is going to be and what kind of rules you're going to use. It's not just a one size fits all. Use the 50-day moving average. It doesn't work that way. But I can tell you this: the key to low drawdowns and the key to making consistent returns is to sell into strength. Okay. People say, well, I'll wait for it to go below the 50-day. Well, what if it runs up and it's 40% above the 50-day? You're going to let it come all the way back down and get below the 50-day and give all that up? You're going to have gigantic drawdowns. So it's not that simple. Selling at the strength, you're always at your equity high. Even though the stock may go higher, your equity is at the highest point. You're getting out at the highest point. If you keep getting out at the highest point, what would happen to your equity curve? It would be like this. It would be straight up. It would never have any downside. So that's the real key, is to get out when the getting's good and to sell into strength. And that will keep your drawdowns. That's one of the keys to keeping the drawdowns low.
Perfect. I'm very curious. I'm just going to dig a little bit further in here. On the average day, is most of your trading happening during that first hour and last hour where the majority of the volume is occurring?
It's happening whenever the stock tells me to get in, and whenever it moves through the pivot point or my buy point. So I don't really have, in certain periods, certain markets, you'll have it where, everything's early in the day. And then there's other times where it won't be like that. You'll get a lot of late day. So it's more thematic. I can't say that over the years, I can say that it's always in the morning. That's just not the case all the time. Although it's very thematic. What I try to do, I look at the market each year as a 12-inning ball game. And I know I've got a long time. I've got a year to put down my return. So I'm never in a hurry. So in the beginning, I'm just trying to not lose money, okay? Make some profit so I can finance my risk going forward, so I can finance more aggressive trading, and figure out what's the theme. What's going on here? What's the technical theme? What's the overall theme? And what's the technical theme? Because sometimes you'll get, for instance, 1995. I didn't start getting heavily invested till the market was in new high ground in April of 95. It was one of my biggest years ever. I was up over 400% that year. There was all power play high tide flags. I called it the year of the high tide flag. There was tons of powerful setups. So I saw this proliferating and they were working. And I just got super aggressive in all these power plays. You can go back to 1990, going into 91. That was the year of the big cup with handle. Matter of fact, Investors Business Daily had a front page. It said, cup with handles proliferate. That was their headline. And then they showed all these charts in the stocks and the news of all these cup with handles. It was Microsoft, Home Depot, Philip Morris. Back then, some of these were actually mid-cap names. They weren't big companies, believe it or not. And they were all breaking out of these big cup with handle bases. So that was a theme. Recently, we saw in 2021, the theme was pop and drop. At least that was what I called it. It was pop and drop. You had lots of stocks that came out of bases, and lots of them broke out and actually went for 1, 2, 3 days, sometimes 5, 7 days, and they go up anywhere between 5, 10, 15, 20%, but then they'd fall apart. So that was the theme. I latched onto that theme around February. And then by March, I really started to say, okay, this is the theme that I'm sticking with until it stops working. And that's how I compounded that big return. I'm going to tell you right now, my goal, my minimum goal, what I wanted to accomplish in the U.S. Investing Championship, I set out to make a triple-digit return. That was my goal. I said, look, if I don't win it, if I do a triple-digit return, at least it's super respectful. That's a huge return, and I'm still in the of doing what I've done in the past with those triple-digit returns. That was my goal. My goal, of course, I want to win it, and I thought I could win it, but I don't know. There's a lot of great traders out there. Some of them in that contest that I taught. So it was anybody's game, anybody's contest to win. But I latched onto that. For me, it was fortunate that theme was that rapid compounding theme that works great for me, and I was able to really compound those returns a lot throughout the year with big positions.
Perfect. And you led me right into the Investing Championship. So, Richard, let's bounce back and forth with questions on this. My first question is, how did you get involved with this, and why did you get involved with it, and what's been the experience?
You're saying the Investment Championship?
Yes, sir.
So back in the 80s, the U.S. Investing Championship was very prestigious, and it's making a comeback now, which is great. David Ryan, of course, won it 3 times. I went to a seminar and met David Ryan. I was very impressed with David and William O'Neill, and you would get your picture in the front of the Wall Street Journal. It was, like I said, it was a pretty big deal. Barron's back then, that was all you had. Wall Street Journal, Barron's, there's a few publications. It wasn't like now where you've got 8 million outlets. It's no big deal to have your picture plastered on something and to be featured in a story. Back then, it was huge. If you got featured in the story, only a very few people could. Because there were so few publications, only so many people could get featured in a story like that or on the front page. So I saw David Ryan won it 3 years in a row. And then, of course, I read David Ryan, Larry Hite, who was one of my main guys that I modeled a lot of what I do after, which he happens to be one of my very good friends now, and I speak with him all the time. He's one of the most wonderful men you ever want to meet. My goal was to be like that, be like those guys, my goal was actually to break the records. When I read Paul Tudor Jones in Market Wizards, I said, I want to break Paul Tudor Jones' record. That's my goal. He did 4 years of triple digits, and his 5th year was 99.4%. My goal is to do 100% a year average or 100% a year each year minimum for 5 consecutive years. And that's what I set out to do. My goal was to win the U.S. Investing Championship. My goal was to be the next Market Wizard. I never thought they were going to write another Market Wizard book. I didn't know that at the time, but I certainly wanted to be of that caliber. It just so happened that I ended up entering the U.S. Investing Championship in '97, and I won. It just so happens that Jack Schwager wrote another book and asked me to be in it. So 24 years later, Norm Zeta, starts the contest. Or when I entered, it was 24 years later. I guess 1997. I went back in 21. I entered against everybody's advice. Everybody I know said, "What are you, crazy? I mean, that's stupid. You have everything to lose, nothing to gain. You're already known around the world. If you're expected to do well, if you don't do well, they're going to say, see, it was a flash in the pan." So that made me want to do it even more. So I did it because I wanted to show nothing about me personally, but just to show that what I do is timeless. it's timeless, and that anybody can do what I do. If you read my books and you work hard, that it still works, and it's always going to work. It's never going to stop working, because the principles that I am teaching forward are timeless, and they're never going to not work.
Perfect. So I think I'll ask the next question. So Mark, last year, it seemed like you were training incredibly aggressively. So I'd love to hear kind of the specifics when you would enter a position, how you kind of incorporated leverage into, right as the stock's going through the buy point, how do you use leverage to increase your returns? And what was kind of a typical position size for you to take last year as you try to concentrate into your best ideas?
Well, so very simply, a progressive exposure I use not only on a daily basis, but also on an intraday basis. So let's say, in the morning, I go into a few trades and they're smaller, but they're working, and I'm profitable. I might get more aggressive now because things are working, of course. So it's always on the heels of success. That's the main thing that would get me more aggressive. And also on the heels of success of closed trades that would maybe happen in previous days and weeks and months. So for instance, if I have a great week, I may be more aggressive that next week, or if I have a great month, I might start that next month being more aggressive, as opposed to, if I have a terrible month, well, I'm going to be going super, super light and just trying to rebuild very, very slowly, and try not to dig any deeper in the hole. So that's sort of the big picture around, or the big thinking around getting aggressive. At times, believe it or not, I wasn't aggressive that much as far as on average. On average, I was in smaller positions and in cash a lot of times. But when I did get aggressive, when things were working, I would take some really big positions. And when I say big positions, I was 4x leverage my whole account sometimes in one name. So, but the way I looked at it was, it's like with with sports, professional sports, or the NFL. You have to take steroids, because the guy on the other side of the linebacker on the other side, the guy that's facing you, he's on steroids. So you can't compete unless you're taking the performance enhancing drugs, or you're going to get mauled. Well, when you get in a contest like that, you got to realize that there's guys that are willing to put their whole account in one name and shoot for the moon, and they might get lucky. And they might get lucky, right at the end, or enough where it gets them such a lead. So you're going to have to be, super aggressive. It's like the Olympics. The competition is so tight that everything's got to be perfect, and you've got to be at your absolute top performance, because the difference between the winners are going to be tenths of a second. And that's how I felt. At least that was the respect that I gave the other traders.
Love it. All right. We have just a couple more questions here. How are we doing on time? Doing good? 5 minutes? Perfect. Okay. We're just going to do one more question
That's
each.
all. We're almost done.
I know. I could go all day. Twitter Spaces, though, we'll have you back. Hold them to it.
Thanks.
All right. I just have a couple more questions here, and I'm going to go with one because I know Richard has one that he really wants. And so we have a lot of retail investors in this room, and I think we go into this with an understanding that it's not the retail traders that are moving the market. We're playing that institutional game of the market makers. So to the retail investors who are in this room, a little bit of the parting words here. What's the general advice you have to them? It's not. I think a lot of us, the goal here isn't to become necessarily, the generational next, Elon Musk or Bill Gates from a wealth perspective, but rather, we want to be comfortable. We want to have some supplemental income. We want to be able to take vacations to Vegas, right? And maybe throw some money on blackjack. We want to be able to have a good time. What's your advice to retail investors approaching this market, this year with a mentality to try and be a winner?
Okay. Well, first of all, you said market makers, and there are no market makers anymore. It's all computers. So don't think the market makers are out to get you, or there's some conspiracy, because that's ridiculous. They're the institutions. Yes, like you see now, the stocks are getting clobbered and having these giant declines. That's institutions unwinding big positions in some of these names that they've built up these big positions over sometimes decades and years and decades, and now running for the exits all at once. So that works on the upside and the downside. So the first thing is you want to get yourself, you want that wind in your sails. Okay. the first thing you have to realize is that you don't want to be going against that big money. So you've got to figure out how to identify when the big money, when the wind is in your sails, as opposed to when you're sailing into the wind. And I see a lot of people, they make these big fundamental cases, but they're buying stocks that are being sold by the institutions and are under incredible heavy pressure and distribution. And that's a tough way to go. But generally speaking, if you're new, the first thing is you've got to get the risk side down. You've got to realize that the key is to not lose. Winning big, I know it's fun and we all want to win big and we all want to trade a lot. Well, I don't want to anymore. I'm not that excited about trading like I used to be, but I know you just want to be in there and have action. And that's what kills you, sitting out and not losing money and being very, very meticulous with your buys. That's one of the first things. You got to be willing to do things that other people are unwilling to do. Whatever you hear everybody's doing is probably not the way to do it. And you're going to have to commit to a particular style or strategy and understand that there's one word that you have to come to grips with anything that you do in life to become great at, and that's the word sacrifice. You can't be good at one thing or great at one thing and be great at other things too. You could be maybe okay or pretty good at a bunch of things, but if you want to be really, really great at something, it usually takes everything you got just to do that. So, that's what I did. I made a commitment to a style. And we've been talking a lot about risk. When I finally decided, I drew a line in the sand and I said, this was in the late 80s. I said, I'm never, ever taking a big loss voluntarily ever again. If it gaps down on me, okay, then I have no choice. I'll sell at the next best price. But I'm never voluntarily taking a big loss ever again. If I'm going to lose at this, it's going to be one small loss at a time. They're going to have to nick me to death. And I made a commitment to that. I made a commitment to a style, a strategy, a certain method, and then said, I want to be the best at this particular style. My goal is to be the best in the world at this style, the best risk manager. My goal was never to make the big returns. My goal was to be the best risk manager and just expose myself in the areas that had the big potential. And I knew that the upside would take care of itself if I just took care of the downside. So, and the other thing too is that you got to realize, and this is one of the reasons why I do what I do, and I write books, and I stay doing this, and I spend so much time on Twitter. The reason why is because I didn't come out of an Ivy League school, and I didn't work for George Soros, and I didn't have mentors, and I didn't even have an education. I dropped out of school at 8th grade. I had no money to start off with. I had a very, very tough upbringing. So it's for inspiration. If I can do it, anybody can do it. And that's the real key. You have to believe in yourself, because it's going to lean on your Achilles heel, your emotional Achilles heel, like you never saw in your life. And, and maybe some of you guys had a really good start in a bull market and you think this is easy. It will destroy you and rip you apart emotionally, financially. This is a serious game, with people like me on the other side of the trade, with professionals, or in the same arena as you, vying for those dollars. So you've got to believe in yourself and stick and know that if you stick with the discipline and you work on specializing and perfecting something, that you eventually can be great at it. But if you're all over the place and every time you have some problems, you lose faith and you try to find the holy grail, and you're always looking for the best, bigger, better deal and the hottest deal, you're going to be a jack of all trades. You're never going to be really great at anything, and you'll never accomplish anything really great. And that can go with anything, whether it's sports, trading, business, doesn't really matter. That advice is universal.
Perfect. You just kind of stole my usual final question, but I'll finalize with this, Mark. What kind of resources would you recommend traders who want to learn more about your style? What should they look? What books should they read? Where should they go? What videos? What kind of advice do you have on that regard?
Well, certainly depending on the style that you want to, that makes sense to you, something that, you want to make sure that whatever you're doing makes sense to you, that you could have some faith and belief in, at least from conceptually. So, if you're my style, of course, I have books that you can read, and William O'Neill's books are homogenous with my books. If you read O'Neill's books and my books, it's like volume 1, 2, 3, 4, and you're on the same field. If you're reading Warren Buffett's books and Ben Graham and things like that, and then trying to marry that with something like I do, you're going to have problems. So it depends on your style. I think, if you want to do the type of style that is a growth style, more momentum, more of the type that you can turn over the edge and have the consistency, I would read just my books and O'Neill's books and read them over and over and over and over, as opposed to reading lots of books. You might want to read lots of books just to be well read and to have good conversation at parties. But if you really want to learn how to do this right, you need to get focused. There's tons of resources on Twitter and all kinds of, I know there's 8 million mentors now, and everybody is a mentor and everybody's got some type of channel or a program, but there's some really good people out there, really, really great people that have some wonderful things to share. You just got to find it and see if it makes sense to you, and make sure they've got a track record or they've got some success. And again, it doesn't mean that you might get a coach that he's not a great trader, but he's a great coach. And I said this one time on Twitter where I said, I don't ever listen to anybody who's not successful. And people are like, well, that doesn't make any sense. This guy was a great basketball coach, but he was never a great basketball player. Yes, but before I listen to him, I want to make sure he's a great coach. See, if he's a great coach, he's got to prove that to me. If he just coached a team to the NBA Finals, well, now I know he's a great coach. So it doesn't necessarily mean a trader has to be this great trader, but maybe he's coached great traders. Maybe they've got a track record of having a real great program. So that's another way that you can maybe evaluate someone that can help you.